All right, let's get right into it. Some of the biggest, most powerful players in the entire home building industry are flashing a massive warning signal about where the U.S. housing market is headed in 2026. Now, this isn't just some vague prediction. It's a very clear message, backed by billions of dollars, that suggests major home price cuts are coming. And trust me, understanding this warning now could be the key to making a very smart decision over the next year.
And just to show you how serious this is, we're kicking things off with the single most powerful piece of evidence out there. Just look at this. Lennar, we're talking the second largest home builder in the entire United States, has been forced to slash its net new order price by an absolutely staggering 27% from the peak of the market back in 2022. This isn't just a tiny price trim to move a few houses. No, this is a seismic shift from an industry titan, and it tells a story that frankly a lot of people are still trying desperately to ignore. Now, we are about to unpack what this all means for you, for the market, and for the economy. But before we jump in, don't forget to like, share, and subscribe. And check out the links in the description if you're looking for a real estate agent in your market or you need life insurance. My team and I can help you anywhere nationwide.
Okay, so here's the game plan for today. First, we're going to dig into the real, on-the-ground evidence of this builder warning. Then, we'll unravel this tale of two markets that's causing so much confusion. After that, we are going to settle the great price versus rate debate to see what's really stopping buyers. We'll explore the psychology of denial that is a grip on the resale market, uncover some surprising opportunities that this correction is creating, and then we'll wrap it all up by asking the million-dollar question, is the resale market about to be dragged down with the builders?
All right, first up, the Builders 2026 warning. Let's look at the hard evidence. We're not dealing with theories or forecasts here, folks. We're talking about what is happening on the ground right now in real communities. This is what this warning signal actually looks and feels like in the real world.
Just look at that number for a second. Negative 27%. Let that really sink in. This isn't a discount on a new car or a TV. We're talking about housing, one of the largest asset classes on the planet. For a national home builder of this size to cut prices by over a quarter, well, that's not just a warning flare, that's a full-blown distress signal. It means they will do whatever it takes to move inventory, because for them, holding on to empty houses is financial poison.
So what does a 27% cut actually look like in cold, hard cash? Well, here you go. At the absolute peak, Lennar's average new home was selling for over $500,000, $511,000 to be exact. Today, that same average new order is down to $375,000. That is $136,000 wiped clean off the price tag. This isn't what they hope to get. This is the price they are actually signing contracts for right now.
And you know, this is a big deal when the story breaks out of the financial news bubble and goes completely mainstream. I mean, the price cuts are so deep that even former President Trump has been posting about them. When something hits that level of public discourse, you know it's not just some niche market trend anymore. It's a real issue that everyone is starting to pay attention to, which just adds more and more pressure to the situation.
So you might be thinking, okay, sure, that's a huge national average from a giant builder, but what about in a real town? Where are these price cuts actually taking place? That's a great question. Because the story gets even more powerful when we zoom in on a very specific, and I think very surprising location. Let's take a trip to Athens, Alabama.
Now, this is where the story completely shatters the myths. People assume these massive price cuts must be happening in, undesirable areas. But check this out. In Athens, Alabama, right next to the booming Huntsville metro, builders are selling brand new homes for as low as $240,000. Now, look at the other numbers. The median income there, nearly $100,000 a year. The public schools, they have a stellar 9 out of 10 rating. And the property taxes, wait for it, about $850 for the entire year. No, that is not a typo. This isn't some struggling town in the middle of nowhere. This is a high-growth, high-income area, and builders are still having to slash prices this dramatically. That tells you everything you need to know about the affordability crisis. It's hitting everywhere.
And this brings us right to the heart of the confusion in the housing market today. This massive disconnect that I call a tale of two markets. This right here is the reason you see one headline screaming about a housing crash, but then you look across the street and your neighbor's house is still listed for a ridiculous 2022 price. It feels like two separate realities because, well, it is.
And this slide lays out the split perfectly. On one side, you have the builder market. Think of them like a car dealership. They manufacture a product and they have to sell it to stay in business. They can't get emotional about it. So they do what any business does. They slash prices, they offer incentives, they do whatever it takes to move the metal. But then, on the other side, you have the resale market. These are regular homeowners. They're not a business. They are deeply emotionally invested. They remember their Zestimate from 2022, and they are anchored to that number. They are simply refusing to cut their prices, creating a massive standoff in the market. And this divide isn't just about who is selling. It's also about where they're selling. Your personal experience of the housing market right now is completely dependent on your zip code. If you live in the Sun Belt, Florida, Texas, Arizona, places like that, you saw a historic building boom. Now there is a massive oversupply of new homes, and all that inventory is putting huge downward pressure on prices. But if you live in the Northeast or the Midwest, say Illinois or New York, it's a totally different universe. They didn't overbuild. In fact, they still have a critical shortage of homes for sale. And that basic supply and demand is keeping their prices stable, or in some spots, even climbing. You have to understand this geographic split to make sense of the national picture.
Okay, this takes us to the absolute core of the problem. We know sales have completely stalled out, but there's this huge debate raging about why. Is it all about high mortgage rates, or is there something else going on? Well, let's settle this debate once and for all by looking at what actual buyers are telling us.
Let's be perfectly clear. For 3 straight years, home sales in the United States have been in a nosedive. We're talking about sales volumes hitting near record lows. Demand has cratered. Now, the easy narrative, the one you hear all over the news, is that it's all about mortgage rates. Oh, it's the 7% rates. But is that really the whole story? What is the primary roadblock that's keeping millions of would-be buyers sitting on the sidelines?
Well, we went out and asked them. This poll of over 5,000 people tells you everything you need to know, and the answer? It's not even close. Look at this. A massive 40% of potential buyers said they might buy if prices drop. Now compare that to the number who said they might buy if rates drop. A tiny 5%. The message from the market could not be more clear. For every one person sitting on the sidelines waiting for rates to fall, there are 8 people waiting for prices to fall. The problem isn't the cost of the loan, it's the cost of the house itself.
And really, this is the fundamental truth of the current market. Home buyers are not irrational. They have common sense, and they can look at history. A 6 or 7% mortgage rate, when you look back over the last 50 years, is completely and totally normal. It's basically the average. You know what's not normal? A house that was worth 300 grand suddenly being listed for 500 grand just 2 years later. Buyers recognize that the insane pandemic price surge is the real bubble, not the interest rates. And they're essentially on a buyer strike until prices return to planet Earth. All right, we're about halfway through, and we've still got some really important ground to cover. So this is just a quick moment to say, if you're getting value out of this breakdown, before we jump back in, don't forget to like, share, and subscribe, and check out the links in the description if you're looking for a real estate agent in your market or you need life insurance. My team and I can help you anywhere nationwide. Okay, let's get back into it.
So if buyers are on strike and builders are in a full-blown price war, that leads to the obvious question. Why isn't the regular resale market getting the memo? Let's talk about the powerful psychology of denial and the mountain of evidence that so many sellers are choosing to ignore.
I mean, at this point, the signs are just everywhere. It's overwhelming. You have the U.S. Treasury Secretary going on record and saying, quote, "We're in a housing recession." That's not some random YouTuber. That's the U.S. government. Zillow's own data shows that over half the homes in America lost value last year. We've already talked about the 3-year collapse in sales. And on top of all that, we're seeing a huge surge in delistings. That's when sellers just give up and pull their homes off the market because no one is willing to pay their fantasy price. The writing is on the wall in giant flashing letters.
And you've probably heard that old saying. But, it's not just psychological denial that's freezing the market. There's a very real financial trap at play called the golden handcuffs. Think about it. Millions upon millions of homeowners are sitting on these incredible 2.5 or 3% mortgages from the pandemic. For them to sell their house and buy a new one, even if it's a cheaper house, they'd have to trade in that beautiful, low-rate mortgage for a new one at 6 or 7%. Their monthly payment would go through the roof. So for many, it's not just that they don't want to accept a lower price, it's that they literally can't afford to move. They're stuck. Okay, so all of this sounds pretty turbulent, I know. But here's the thing. Every market correction creates opportunity. And for the savvy buyers and investors who are actually paying attention, these builder price cuts are opening up the first real chance to find value that we've seen in years. Let's pivot and talk about where you can actually find it.
This is the key takeaway for this section. What's happening right now isn't just a downturn. It's a return to sanity. It's a normalization. For the first time since before all the pandemic madness started, we're finally seeing prices in certain areas that actually make sense from an investment point of view. For cash investors who don't have to worry about high mortgage rates, the math is finally starting to work again. The kind of returns we're about to look at, they were pure fantasy just a year or two ago.
Let's look at some real-world numbers.
If we go back to that Athens, Alabama example, with the low prices and incredibly low taxes, a cash buyer could see a cap rate of around 6%. A cap rate is just a simple way of measuring your annual return on a cash purchase, and 6% is pretty solid. But check this out. Near Nashville, another giant builder, D.R. Horton, is selling brand new townhomes for just under $200,000. We know for a fact those exact units are renting for $1,650 a month. You do that math, and it comes out to a 7% cap rate right out of the gate. These are the kinds of healthy, fundamental numbers that have been missing from the market for years.
And all of this leads us to our final and most critical section, the 2026 showdown. You have two markets on a collision course. The builders are in a price-cutting frenzy, moving aggressively to adapt to the new reality. Meanwhile, the resale market is frozen in place, paralyzed by denial and his golden handcuffs. These two opposing forces cannot coexist forever. Something has to give.
So, how can we predict which side will win this fight? Well, in any market, you have to look for what's called a leading indicator. A leading indicator is just the first domino to fall. It's the signal that tells you where everything else is about to go. And in the housing market, the builders are always the leading indicator, every single time. Why? Because they're a business, not a family. They have shareholders and payroll and massive loans to service. They don't have the luxury of getting sentimental about a house. They are forced by their business model to be rational and to face reality first. So their actions, these massive price cuts, are telling us exactly where the rest of the market is headed.
And so, that leaves us with this final, unavoidable question. The builders have laid their cards on the table. Through their actions, they've made it crystal clear that they believe the pandemic-era home prices are completely unsustainable. They're adapting to the new reality of what buyers can actually afford. The question that is going to define the housing market in 2026 is simple. How much longer can individual home sellers afford to ignore this clear, undeniable signal being sent by the biggest players in the game? That is the showdown we were all about to watch. I really hope this deep dive has helped bring some clarity to what's going on in this very confusing market. As always, thank you for watching. And one last time before you head out, don't forget to like, share, and subscribe. And check out the links in the description if you're looking for a real estate agent in your market or you need life insurance. My team and I can help you anywhere nationwide. We'll catch you on the next one.